This computer.
Awesome.
Hello and welcome back. This is the 10,000 Startups podcast, where each week we bring you original content from subject matter experts on items of interest to startups. My name is Roger Royce. I'm a partner with Haynes Boone in Palo Alto, California. I do emerging growth and venture capital. And this week, we are going to talk to Kim Lee, Kick-Ass Kim, they call her, for what she does in outsourced accounting. She helps growth stage companies scale with clarity and confidence through GAAP accounting. We're going to talk more about what that means, automation and internal controls. She's a founder herself of her company. She's been 25 years in Silicon Valley, started her firm 2003, I guess it was. It's about when I met you, Kim, I think.
Yeah.
Um, Before that, she was with a Big Four CPA firm. And now she's working on automation, accounting, internal controls. She has some of the biggest names in the Valley as her clients, but also does a lot with startups. So welcome, Kim. Thank you for being here.
Thank you, Roger. I am excited because you have been doing this for a while, and a lot of times I like the conversation. Like you share a lot of war stories, and so that's what I'm expecting today.
Yeah, well, we'll talk about a couple of them. So let just by way of introduction, maybe you could just give us a quick picture of what you do, kind of focused on startups. I know you do small and big companies, but on the startups, what kind of service would you typically provide?
Yeah, so I typically focus on Series A and B companies, and those are where it's accounting operations. Beyond the bookkeeping side, it's now the workflows, the approvals, setting it up when they have institutional investors that they need credibility, like the CEO, CFO need credibility, need to, it's someone else's money, right? You need to have, you have that fiduciary duty. And so that's our specialty.
Okay. Well, let's kind of rather than let's kind of drill down on what's really important to startups when it comes to bookkeeping and accounting and controls. And you may recall, those of you that went through my legal foundation series, we did an entire hour on accounting because it is so important to startups. So my first question to you is, usually the first time a founder is going to think about these issues seriously is when they open a data room and show it to an investor. And an investor, it's the first time someone from the outside is going to look at their books. So, just to be practical here, what's going to make them nervous, the investor, when they start looking at a startup's accounting systems?
Yeah. I think you, Roger, have the best view into that in terms of can you share? Because you're the person interfacing with investors most. First, can you share some of the stories you've run into?
Well, well, I'll tell you from my perspective, by the time you have a data room, you better have a system. And I've seen companies, it's crazy. I've seen companies doing, I'm not making this up, doing $300 million financings that didn't know how to properly account for liabilities. So they put books up in their data room with zero liabilities, which, as
Oh,
you I know, as an
wow.
accounting matter, is pretty much impossible. If you have one employee, you have a liability, right?
Wow.
So that's the kind of thing that will stop a deal dead in its tracks. How about you, Kim? What have you seen?
Yeah, it's actually, you're exactly right. Accruals. I know for founders, it's like, what the hell is that? Like, I keep all of my expenses, but it's things like leases that you've entered into that are coming up, or I have clients, actually, I have some really good clients. So their CFO or their fractional CFO is on top of it. But lease commitments or equipment that they bought, they received, but they haven't gotten the invoices for yet. And those are sometimes big dollars that when we look at it, they'll be like, what happened to that contract you signed last month? We shouldn't, and you got the equipment. So very big dollar amounts that I've seen. And other types of commitments they've made to other people, like I'm going to give you X warrants or Y warrants. We never see it on the cap table. And I typically remind them, whatever you've promised people, at least put it on on a list somewhere.
Yeah, and you know what I tell founders is that mistakes are free, until you get an investor involved, but you cannot give inaccurate information. You can't just say, "Oh, my bad, let me go fix it," because you just lost all your credibility. And not just the financial credibility. It's sort of like, well, if you're sloppy about your accounting, what else are you not telling me? So I think it's pretty important. But the question is, how important is it? What's good enough? I mean, not very many startups can actually do a full-blown audit by the time they get to their first investor. So what should they do? Series A, Series B, that kind of thing.
Yeah, I would definitely say accruals is the most basic that you should do, what's coming in. Most of my Series A and B actually skip what the revenue recognition. Like typically you have to go out and get a technical accountant, write this big memo. They typically divide it equally over a period, which I think is acceptable as long as your investors know. Most of my A and B also skip the technical accounting for all the equity instruments, warrants, different option types, different types of equity instruments because they get so complex and it's you pay money between 5 to 10 grand to get these memos. So okay, don't hold it against me, but I personally don't think that's the best use of your time until you go through an audit. Just keep a complete list. I don't know, like, is that good advice, Roger? Or did I just like,
Well,
I'm practical. I'm
let
very
me kind of
practical.
drill down on that a little bit. How, again, on this, how good? I mean, keep a good list, make sure it's accurate. Because the question I always get is like, at what point do I need a CFO? At what point do I have to actually appoint, an internal accounting officer, to scrub this stuff? And I have a sense that maybe that's where you come in for companies that don't quite get to that point yet, or maybe even after.
Yeah. So we typically come in as they are getting like after Series A funding, and there's the compliance of not just books compliance, but sometimes our clients have gotten payroll tax audits, R&D tax credits that you're applying for, and someone has to gather that data to do. Then typically we have a fractional CFO. Our clients do a fractional CFO. The fractional CFO is really important. We don't provide that, but the fractional CFO is your fundraising, it's your forecasting, it's strategic. He or she teams up with the CEO. What we do find is that some companies underestimate the amount of keeping up with the compliance. Let's say you, Roger, they do a funding and you give them the checklist of remember every month, send in your covenants, send in financials. Founders get really busy and they forget that, or bookkeepers won't do that for you. So those are the typical gaps. I don't, is that what you see as well? I'm trying to
Yeah,
triangulate.
and you've kind of hit on something that people just forget about is those covenants, right? If you're dealing with a sophisticated investor, you're going to have covenants, financial covenants. And what we mean by that is you have to meet certain financial metrics and you have to accurately report those. And if you don't measure it, you can't fix it, right? So you really have to pay attention to that. So let me ask you a question. Most of my clients, it's kind of funny when you and I started doing this, everybody was going to go public next year. Now
Yeah.
everybody's going to raise their Series B next year. So suppose that we have a company and they're going to raise their institutional round in about 12 months. What should they be thinking? Because you've convinced me we don't want to wait until after we sign the term sheet to start fixing stuff. What should they be thinking about right now?
Yeah. I would say that definitely getting their books in order, that if your investor said, can you generate financial statements from last year, last quarter? If you can't easily do that, then let's get started on that. Reconciling your cash, reconciling some of those basic accounts, because when they drill in, they're going to ask you, what did you spend this on? Right. If I'm going to give you money, typically it's payroll, which is good, equipment, which is good. Sometimes we even have people who buy equipment that they don't even track. They don't have like a fixed asset tracking. And some of these servers are getting to be super expensive on the AI side that you're investing in and not having even that basic. And what we find is finding those documents themselves, organizing it is where it's a slog for founders. It's a slog for really technical people. It's not the best use of their time. So we typically say, here's a folder, put everything you have in there, we'll sort it out for you, and then we can fill in the holes. But it takes longer than they think. And even me, like I'm like, oh, it's somewhere in this email, somewhere so and so. Roger sent me something important. Let me go find it. The hunt and peck for that. So it sounds tactical, but it really is gathering that piece by piece instead of waiting for that fire drill. And you, Roger, say, load up all your documents. I'm like, I can't find them.
Oh my God, yeah. Okay, let's shift gears for a bit. So here's the other thing where this sometimes becomes a little bit of a surprise. We do the round, we close the financing, we start having regular board meetings with outside directors and investor directors, and we have to report, usually on a quarterly basis. And that report is a narrative and it's a PowerPoint and how we're going to change the world, but it's also financials. And I could tell you almost humorous stories about the first time that investors see like really scrubbed financials. And it's like, oh, but aside from that, what is it that the company, what does a proper reporting package look like? Quarterly reporting package look like for a startup company that's just gotten financing?
Yeah. I would say first is that executive summary, as you say, here's where we spent most of our cash, here's where we're using it, here's where last month or last quarter I budgeted $1 million, it's less or more, that narrative. But the credibility I find comes in, here's the details, the exhibits, here's the balance sheet that you can actually say, here's a list of my assets that I did buy, or here's where I spent, I have head count. Right, head count is important. The metrics, if you're doing ARR, MRR, anything like that. But Roger, I actually want to hear from you. Tell us a story of where, like, you're in that board meeting, and the board is asking some of these questions, and the founder's like, "Holy shit, I made that up. I don't know." Like, tell us.
Well, I'm never going to admit to that, but that they say that does happen in the valley, but it's rarely kind of that blatant. It's more that the investor maybe didn't ask the right question, or the financials didn't really highlight something that would have been highlighted in a footnote if they somebody had put a little more time into it. In particular around costs. What you said about accruals and revenue, that's a big one. Absolutely, that's huge. But I think everybody kind of anticipates that. So that's one that you would expect a sophisticated investor to figure out. Where I've seen them get surprised is on the cost side sometimes. It's like, oh, we didn't know it cost that much to get there. We didn't know that was the burn rate, or that was the runway, or you didn't factor into all this other stuff. And that's at a higher level. The more basic ones I've seen is where is really related and affiliated transactions where money goes into the company, and then just it goes in, goes in the front door and out the back door to, pay a big bonus or a salary or something. I don't want to drill because I could tell you crazy stories, and it comes up in board meetings. I because that's when finally somebody is reporting and we're approving, and all of a sudden it's like, why does a company have a company Corvette? Or stuff like that.
Yeah, yeah.
Um,
Sure. Oh, I was going to circle back a bit, Roger, on the expenses. And you asked about a board package. What we typically also do is we do variances we'll write that so that the CFO can message it. But more importantly, let's say quarter over quarter. Last month, software license was, let's say, 100,000. This month, it's gone to 200,000 because, we've invested in more subscriptions, we've done something else, writing those little notes so that you can remember. And that's the credibility that investors are looking for. If you can account for those and say, as you've said, we didn't think we need two servers and it was too slow, and we did that. That really helps founders a lot.
Yeah, absolutely. Well, kind of on that point, and before we even get to the quarterly meeting, so now we've got a closing, and I have a nice little post-closing checklist that I like to use, and I know you do too. But what's on your closing checklist as a financial matter for founders post-close?
I was going to ask you that question, Roger. So I wanted you to go first because I actually think that you are the lead. Typically, you have the strategy where you're negotiating on behalf of the company, where the investor might want audited financials, and you're like, no, can we just do financial statements, right?
Mhm.
So I actually think it starts with you as the lead of what are the documents to report, and then what we do is take that and make sure we comply with what you've agreed to, depending on the investor. So can you go first?
Yeah, there you go. Well, I push hard on the financial stuff. I know a lot of people just kind of gloss over that because they don't understand it. But there is a world of difference between an audited and an unaudited, and even a reviewed financial. And so I'll push hard against audited financials early rounds, but once you get to the later rounds, forget it. You're going to lose on that because, one thing about VCs is that they're all good bureaucrats, right? And they know how to dot the I's and cross the T's and check boxes because they have their own investors to report to. So and we've all seen the news about some of these big deals, that turned out to be complete frauds. And I recently did a podcast on how even an innocent investor in a fraud, they're not only going to lose their money, they might have liability to other people for allowing the thing to proceed or have to disgorge some of their own profits. So because of that, we are going to have to eventually do audit it. But aside from the audited statements, there's the internal reporting. There's the quarterly, maybe they get a flash report, every month. Maybe they'll always get a narrative. There's stuff like that. So founder, you better start, immediately, as part of your closing, not only have good financials at closing, but start putting some discipline in place going forward. And I'll just say it, that means more than an Excel spreadsheet. That means more than just you and your QuickBooks because it's just so easy. How about you? What's your perspective?
I'm going to circle back on the comment you made as a lawyer who's strategic, advising clients, number one, to if they can avoid the audited financials, you've literally saved them between 50 to $100,000 per year. So I'm going to circle back because you take it for granted, but I'm going to show you how extensive the work is for the company. When you get audited financials, you actually need the auditors, number one, you're paying the auditor cost. You actually have to pull all of these documents to put the audits together. And so the longer you can delay it, the better. It doesn't mean to keep sloppy books. That's actually more incentive to keep good books so that your investors trust you enough not to require the audited financials. So having an advisor like you that will fight for, hey, can we just give you compiled? Can we give you, as long as they're clean financials that have balance sheet, income statement, the accounts are reconciled, the quarter over quarter, year over year, like the entire complete package. And if they can avoid that, that's $100,000 you've just saved the company. Okay.
Yeah.
And yeah, and then when you get to Series B and it's bigger dollars, totally agree. And that's where we end up helping gather support to do that, to pass the audit. But that's one area founders underestimate how much of an asset you've been to them by keeping it as narrow as possible.
Okay, thanks. Let's move along the life cycle of the startup and talk about M&A a little bit because I've been doing M&A for a long time, and my perspective on this is 20 or 30 years ago, the financial side was, yeah, we're going to leave that to the accountants, and lawyers didn't really have to know much about it. These days, M&A is, and I think it's probably because of the dominance of the big four accounting firms in almost every area of consulting. M&A has become very much a financial exercise, an accounting exercise. And we spend so much time, looking at the accounting and making sure we're not going to have a million adjustments post-close that surprise us. And the other part of it is because M&A deals are oftentimes a multiple of EBITDA. We have working capital adjustments, which is an accounting issue. We have purchase price adjustments, which is going to be another accounting issue. So I want to talk to you about M&A. So the first thing is tell our audience and me, because I can never remember, what's a quality of earnings report?
That would actually, you have the better perspective. I have the practical one, basically proving whatever your revenue, whatever your net income, whatever you're saying you're going to have, it's supported. It has the contracts, it has the cash receipts, it has all of the supporting documents, not a estimate. So that's the more practical side. But I think for you probably have a better idea of the definition and how you even negotiate what is included or not included in some of those calculations, don't you?
Yeah, I mean, my approach, and I don't know, maybe some people might think it's overkill. They'll think that until you actually get to see those adjustments. Then it is money well spent. But my approach is not to just say it's gap and move on. And gap, as every our audience recalls from our podcast, is generally accepted accounting principles. It's because gap's a range, right? Could be a lot of things. It's here's a schedule. We're going to attach a schedule. These are our accounting principles. These are the accounting rules that we are going to apply on all of these items: revenue recognition, expense, capitalization, amortization, all this stuff, because we don't want the buyer saying, oh, well, my gap is this. So we're going to change all your records now. And oh, look at that. You have lower EBITDA and therefore a lower purchase price. We don't, if we have those kind of surprises in a deal, oh my God, we did not do our job. What do you think?
Yeah, yes, I agree, especially some of the equity adjustments like stock-based compensation expense. Some of my smaller clients are like, it's non-cash. And so they don't end up recording it. But when you actually do, if your buyers or investors are expecting that, adding that number really lowers your net income. And then there's a big surprise. So exactly as you said, what's the assumption? The assumption is I'm going to have a complete list. Do I do the Black-Scholes model and just record that, but it hasn't been fully vetted from a technical accounting perspective? What's that level of granularity, so that the founder doesn't walk away with less, right? At this point, the founder is expecting, let's say, 10 million, 20 million. And then by the time you add these adjustments, those are expenses that aren't cash expenses. So that's one that I find surprise people.
Yeah, the one that really confuses people because it is so counterintuitive and I guess a little metaphysical is the tax provision. And I know there are like people who that's their whole thing. They're experts in tax provisions. That's all they do because it can be so complicated and so hard to understand, even for lawyers. And that's why in deal documents, typically we just ignore deferred tax assets and deferred tax liabilities because nobody knows what it is unless they have someone like you going through their books and kind of getting a fix on that ahead of time.
Yeah, that's a good one, Roger. And even for tax provision, we're not experts, and we also say, hey, that's a separate carve out. Don't expect that because depending on their jurisdiction, U.S., international, the states that they're in, it can be a totally different animal altogether.
Yeah, you just hit on something, international, because what is gap in the US, not necessarily gap in other countries,
Yeah,
right? So now whose gap are we talking about? So it gets even more complicated.
yeah, definitely.
Um, okay, so we're kind of getting towards the end of our time here. So let me give you a couple rapid fire questions here. Uh, Here's one. I'd like you to finish the sentence. The most expensive accounting mistake a startup founder makes is blank.
Oh, oh, I feel like do. Not being prepared with I'd say complete and accurate. It doesn't have to be gap, but complete records, accurate records.
Okay, I'd agree with that. Okay, and my last question. So every founder listening's either in the middle of a raise or they're thinking about a raise, or they're trying to raise money. It's just Silicon Valley. What would you tell them that they should be doing right now, this week, not next year, not after they get a term sheet, not after they close, but what should they be doing right now if they're looking for money?
I think the quick assessment is if an investor came and said, I'm going to give you money now, could you run a package of financials that you can give them with confidence that it's, 80, 90% there. If it's not, that's where you start to go back and say, where do I fill in the holes? And then contact an expert, find someone that you trust, depending on the stage you're at, and start to put that list together and you build up to it. Right. I also think, Roger, lawyer, right? Talking to your lawyer because you will know best. What's the first thing the investors are going to ask for? What prioritize those types of documents?
All right, awesome. Well, thanks for the plug. All right,
No, that's why
Henry.
we work together. It really does go hand in hand, like having that strategic lawyer lead and then having the rest of it cascade after you.
All right. Well, thanks very much. So thank you, audience, for listening. This is Roger Royce with the 10,000 Startups podcast. I've been talking to kick-ass Kim Lee on Scale to Exit, helping growth stage companies scale with confidence through gap accounting and automation and internal controls. Thanks very much, Kim. Thanks, audience, and we will see you all next week.